Of you, a warm welcome. Hello everyone, welcome to all of you accessing this presentation or its recording. I'm Fanny Spinetta. I'm an insurance specialist and I'm also the ambassador of the EDHEC Alumni Club for Risk and Insurance. So we are several clubs in France from various business schools and big universities. So we are very happy to contribute and collaborate to this webinar today. So just to give you some, let's say, administrative information. So this presentation will ask for 40 to 45 minutes. There will be a session as well dedicated to question and answers. So please send all your questions at the bottom of the screen on the Q&A function that you can see on the Zoom. We are, I think, a bit more than 600 professionals registered today. So I have the responsibility, let's say, to select your questions. You, at the end of this presentation today, you will receive the paper of Professor Rebonato plus the presentation, and we will make sure that we answer your questions as well if they are not answered today. So before starting the presentation, let me tell you a few words about the EDHEC. So the EDHEC is a French business school founded more than 120 years ago, encompassing more than 50,000 alumni where in the world. So with, of course, a big academic excellence. And the EDHEC-Risk Climate Impact Institute has two main goals. First, to analyze the impact of climate change on asset prices, and as well to understand how finance can contribute to the transition to a decarbonized economy. So today, I'm very happy to present you Riccardo Rebonato, who is the scientific director of the institute. And Riccardo holds doctorates in nuclear engineering and solid-state physics. He was a research fellow as well in physics at Oxford University. Riccardo has held several positions in finance, in head of derivatives trading, head of risk management, head of research in a number of sell-side and buy-side financial institutions. Riccardo has also written various articles and books as well. The latest book is How to Think About Climate Change within Cambridge University. And today, Riccardo will present you his latest paper, Asleep at the Wheel, the risk of sudden adjustments, to trying to question on the underestimation or neglect of the effects of physical and transitional climate risk on the cash flows of companies and also of governments, and of course the risk of repricing. So I think now, Riccardo, the floor is yours.
Thank you very much. Thank you very much for the introduction, and thank you very much to everybody for attending this seminar. As Fanny has eloquently said, I will be talking to you about my conclusions, my thoughts. I will be sharing my thoughts with you about whether markets are asleep at the wheel. What I mean by that, to what extent are the effects of climate change embedded in today's prices. So this is the outline of a presentation. We'll go through all the different topics. And just to frame the question as clearly as I can, I will start from the following. Many, many studies have been conducted by practitioners and by academics trying to identify either a climate risk premium or a climate beta, either at the aggregate level or at the sectoral level. However, as we shall see in detail, very little conclusive evidence has been found in this respect. This is surprising. How can this be the case? I will present a few possible explanations, but I intend to argue that a mispricing of climate risk is the most likely explanation. What do I mean by mispricing? It means that current prices, I think of a price as a discounted expectation of future cash flows, or future dividends, or future cash flows. So my contention is that the effect of climate change is not fully or appropriately reflected in today's prices of assets in general. If I am right, if this is true, price adjustments will eventually occur because expected cash flows turn into realized cash flows sooner or later. And these adjustments will occur either in a gradual way or in an abrupt way. This is a novel source of risk which should be on the radar screen of all investors, but of long-term investors in particular. So a good place to start is an excellent paper that has appeared very recently. It's this year's paper. And I'll read some of the, a few lines from this paper. It says, while the literature has convincingly documented that climate risks are currently priced across a range of asset classes, much less is known about whether they are adequately priced. So yes, we do find a signal, but it's difficult to tell whether this signal is big enough. And it goes on saying, it is an important question for assessing the likelihood of potentially, and these are the words of the paper, substantial, short-run asset revaluation, as this might be strong. If investors fail to update belief in response to information about future climate, this may reduce the average present-day effect of long-risk physical climate risk. This is an academic paper, so the prose is a bit heavy. So it means if people don't take climate change into account, they're not discounting the effect of climate change, the long effect of climate change into account. And this could lead to a substantial revaluation risk in the case of beliefs eventually move by a substantial amount. So, why do I think that markets could be asleep at the wheel? Well, the first observation is that attempts to detect a climate beta, by climate beta, I mean the sensitivity of different asset classes or the prices of different asset classes to climate shocks. So far, these attempts have been met with very mixed success at best. There isn't even universal agreement as to which assets have a positive or a negative climate beta, apart from the patently obvious ones. And the price sensitivity has always been found to be at the limit of detectability. So it is statistically significant, which means it's good enough to publish a paper, but it's not economically significant, which means it doesn't make much of a difference from the investment point of view. So this suggests that if prices have so far reflected climate information, they must have done so to a very limited extent. So is it reasonable that prices should have moved so little? That's the first question. And the second puzzlement, the second area of surprise is that if this muted sensitivity of prices to climate news, the fact that the prices do not seem to reflect climate news, it's difficult to reconcile with the expected economic outcome of any policy. If we deal with climate change seriously, then the transformation, it is one of the parts that I will be spending some time in this presentation, the transformation of the economy will have to be absolutely radical, with adaptation and abatement costs of the same order of magnitude as what we're currently spending on education or defense. If, on the other hand, the climate change problem is left untackled, then temperatures on the planet are likely to reach levels never experienced by the human species, with potentially serious economic consequences. By the way, to reach temperatures never experienced by the human species, we don't have to go to 6 or 7 degrees. Just 3 degrees centigrade above pre-industrial level is enough to be into uncharted territory. So this is why the muted sensitivity of asset prices to climate innovations constitutes a puzzle. If we act decisively, we should be seeing a rewiring, a huge sectoral effects. If we don't do much, we should have big physical effects. We are seeing nothing. So let's try to be a bit more precise. What could the explanations be? Explanations of what? Explanation of the fact that prices seem to be moving to respond so little to climate information. So these are the most likely, logically, these are the most likely possibilities. I stress logically, not necessarily, when I say most likely, probably, I don't mean in the real world, but logically, these are the things we should be considering. One is that the market is informationally efficient and has already impounded all the relevant information. So there are, everything is already in the prices. Second possibility, the market is informationally efficient, but it expects the climate-related cash flow impairment, so the effect of climate change on cash flows, to be small for all sectors, even if no climate action is taken. So this is, I would say, the belief of, let's call it a climate denier. Oh, it's nothing much. There isn't anything to worry about. And I'll show you that amongst investors, there is not such a fantastically minority view. Or perhaps, explanation number 3, the market is informationally efficient, but it is also confident that we will be able to manage climate risk very effectively, either by adaptation or by emissions or by carbon removal or by carbon sequestration and storage, whatever. It is confident they will be able to engineer a soft landing in the 1.5-2 centigrade that the Paris Agreement identifies as the acceptable temperature increase. Or again, it could be that the market is information literature, believes that there will be damages, but these damages are so far in the future that they have no impact on the prices today. They are effectively discounted away. And ultimately, and this is what I think is the most likely, is that the market is asleep at the wheel, by which we mean that the prices do not correctly reflect expectation and uncertainty about climate outcomes. Here I have some nice pictures. This is a survey which has been made since 2008, every year, by the Yale University Climate Change Communication Center. And it shows in the US, it is US-based, the fraction of the population partitioned by party, partitioned by political affiliation, that believes that climate change, A, is human-caused, that's the top graph, B, they will harm the US. So if you go to conservative Republicans, only 25% believe that climate change is caused by humans. And even if I take in liberal and moderate Republicans or independents, I barely touch 50%. And if I ask the question, will it harm the economy of the United States? 30% of conservative Republicans say they will have no effect on the economy of the US, and it only reaches about 60% if I take into account independent or moderate Republicans. So if these people are right, and I don't believe they are, I strongly do not believe they are, well, then there is no price adjustment because nothing will happen. There will be no harm to the economy. But it is predicated on this view, which is a majority view amongst parts of the electorate, but I wouldn't say is a reasonable view to be correct. And there is another thing that is from a recent clipping from the FT. And the title says, oil and gas groups face virtually no extra costs of borrowing, S&P finds. And he goes on to say, oil and gas groups face virtually no extra borrowing costs with less polluting businesses, despite of efforts by the United Nations and international organization to encourage banks and investors to reduce lending to the fossil fuels. So this reminds me what Greenspan used to say about the effect of computer or in the economy. And he says, I can see the effects of the information technology everywhere apart from in productivity. And here I could say, we can see the effects of climate finance everywhere apart from in the prices. Okay. I think that price adjustments are likely. So I think that these 75% of Republicans, conservative Republicans, are wrong, because if the market erroneously underestimate the reality or the gravity of the climate change, as the corporate cash flows over time turn from discounted to realized, expectations will have to change. So we can remain in a state of denial as long as something is an expectation, but when a cash flow materializes, then we see, oops, the cash flow is lower, and is low, and is repeatedly lower. At that point, valuations have to change. If this happens, this brings about revision in expectation that will give rise to large price adjustments. If instead, remember, the other possibility is that the market is pricing in a soft landing scenario. Well, I hope that we do engineer a soft landing scenario. However, this outcome should not be taken as an almost certain scenario. There is a huge uncertainty, and the degree of efforts which are required to engineer this soft landing at the moment are nowhere close to being met in the world. And if we achieve this soft landing, it would have extremely strong sectoral effects, which instead appear very small. And lastly, it is extremely optimistic, because the 1.5 centigrade target is, in practice, virtually unachievable. And when I say in practice, I don't mean technologically, but I mean fiscally and from the public debt point of view. And if we have time, we can come back to this. And even a 2 centigrade target is what I call a stretch target. So I started this presentation in a way. The premise is that prices do not seem to respond to climate shocks. How do we know that this is true? Well, what is the most direct way in order to see whether prices respond to some factor? The factor doesn't have to be climate change, it could be anything. Suppose that we think of inflation. Then we take a measure of inflation, perhaps it's realized inflation, perhaps it's inflation surprises, perhaps it's break-even inflation, whatever we want. But we have this time series of an observable quantity, and then we have a bunch of assets. And if I look at fixed income assets and treasuries, it is very clear to see that when inflation expectations change, prices change. So I measure a beta. In principle, it's very easy. Unfortunately, there is no obvious observable proxy for climate risk. Temperature is not suitable because it is too slowly moving and too noisy. So different approaches have been followed to create an index, a time series that can proxy for climate risk. For instance, using textual analysis. So looking at how the frequency of occurrence of certain keywords in the press. And the first work in this direction was by Nobel Prize Professor Engel and Giglio. And it was a seminal paper, but since it was the first paper, new researchers, other researchers, also at the EDHEC-Risk Institute have come along, making improvements, but following the same idea. So textual analysis is now able to discover the context. It doesn't just look at the frequency of certain words, like climate disaster, climate emergency, etc., but is also able to tell whether the meaning of a sentence is positive or negative. So these are all machine learning, artificial intelligence advances have been made. So the textual analysis is much more sophisticated than it used to be for the first study. However, the out-of-sample explanatory power of these indices constructed from sentiment analysis has been very low. After controlling for established factors like book-to-value factor, momentum, etc., the incremental R-square statistics is of the order of a few percentage points. Using a state-of-the-art version of this approach, my colleagues Jean-Michel Mézot and Dominique O'Kane obtain statistically more significant results, but then again, only for a very special combination of the several indices they build. Given this problem, some people have tried to do something different. Let me make an analogy here. Another example of a latent, not obviously measurable quantity is liquidity. So we all know it is there, we all know it is important, and we all know that it affects several different things, but none perfectly. It could be the VIX index, it could be the option adjusted spread, it could be the on-the-run, off-the-run spread, whatever. So the idea is to say, let's take the time series of many of these quantities, which are all impacted by liquidity and other things, and create a principal component. As you know, the first principal component takes out the element which is common to all these different factors. And if the element which is common is liquidity, the most important one, then it should extract automatically liquidity. So Keeney and Rubin have tried to do something similar with climate changes, not climate change, but with changes in climate perception. And they recognize that no single indicator is correct, but by putting many indicators together, they hope that when they extract the first principal component, they get the common factor to everything, which should be this climate index. They do it in a super sophisticated way. I won't go, everything is time dependent, very beautiful, very sexy. However, their conclusions is when we use this technique to explain the returns of corporate bonds, we find, and this is their words, a systematic environmental factor does not help to explain bond returns on top of financial standard factors. In the case of equities, only for the most obvious sectors, such as oil and utilities, the increase in R-square is statistically significant, and even in this case, by a very modest amount, just by a few percentage points. I don't want to go too far, but just to show you that people have tried really hard. So another approach is to say, I'm going to do a long and short portfolio, long, say, green assets and short brown assets, and I look at the returns from this long and short portfolio, and the return should be proportional to the latent climate factor. This is a big advantage over the index route. Perhaps there has been a readjustment in prices, but this has occurred as a gradual process of growing climate awareness, not directly linked to specific news. So in this view, it says, perhaps these two portfolios diverge, but not as a response to individual news. But if I do a long portfolio of green and a short portfolio of brown, I should be able to see the effect. But where there is a problem, it is not obvious securities to put in the long and in the short portfolio, so the approach is a bit circular, but let's leave this to one side. Whatever the sorting method, by which I mean whatever method is chosen to put assets in the long and in the short portfolio, the results are far from clear, with the field evenly but unhelpfully split. Half the researchers find that only the returns of green assets are affected by climate risk. The other half draw the same conclusions, but for the brown assets. Again, my colleagues Keeney and Rubin conclude by choosing different measures, one obtains different results. The sign of the greenium, the green risk premium, and hence of the climate beta, is not clear. I should pause for a second, because you might say, but Riccardo, everybody agrees that there has been a flood of money that has come into ESG. And it's true in the last couple of years, they might have slowed down a bit, but obviously there has been a huge influx of money. what the economists call is the demand function has changed for this type of asset. How is it possible that it's not reflected in prices? Well, things are not that simple. And I'm going to give a super stylized description of what is happening. Suppose that money flows into green assets or is taken out of brown assets. Let's consider the case of there is divesting from brown assets by climate-conscious investors. Well, when this happens, the price of brown assets goes down, and therefore their expected return goes up. Now, if there is a substantial fraction of investors who does not believe in climate change, who is not concerned about climate considerations, they now see an asset which is cheaper with a higher expected return, and therefore they preferentially buy that asset, pushing the price back up. So there is a dynamic which is not simple, and my colleague Ramanupal has written a very nice paper on this at the moment, on the allocation effects and the price effects. But therefore, the point I'm making is that even if a fraction of investors changes their preferences in a green direction, and this fraction is substantial, doesn't automatically mean that prices will change. Okay, another important point. We said that a possible explanation of why prices appear to respond so little to climate information could be either because climate damages are expected to be small, even if we do nothing, or because we expect efficient mitigation action. And this efficient mitigation action, we expect it to be able to limit climate change and make its effect innocuous. It is an important distinction. If climate change does not matter, then no big readjustment of the economy will be required. But if it is mitigation and adaptation that will reduce the effect of climate change, this will require a major rewiring of the whole economy, and sectoral effects should be strong. All the studies I mentioned just now, they obviously looked not just in the aggregate at equity indices, but they also looked at sectors, and they failed to find these sectoral effects. So let's look at these two possibilities in some detail. So is it possible that 75% of conservative Republicans are right, that it's a non-issue? Under a business as usual scenario, the concentration of CO2 in the atmosphere will almost certainly is likely to grow at its current rate, which is almost exponential. And this is the rate of growth in log scale of emissions from the 1960s to today, which the best fit is a straight line, still until today. And if I limit myself to the 1960 to today, I have the line which is slightly concave, but really I am a long way from seeing an inversion. If emissions continue along the current business as usual trajectory, temperature increases around 3 centigrade, and possibly more by the end of the century, are very likely. And as I said before, the human species, let alone human civilization, has never experienced these temperatures, because we have to go back about 3 million years to find similar global temperature. Admittedly, the associated economic damages are very imperfectly known. And there are schools of thought that look at tipping points, etc. They say there will be a catastrophe, and there are other serious studies that says, no, it will not be as bad. I'm not going to go into this debate at the moment, but what is undeniable is that there is huge rage on uncertainty. And a number of serious studies do project very severe consequences. So the sheer magnitude of uncertainty about what could happen should be reflected in the prices. After all, if modern finance has taught us anything, is that variance, uncertainty, affects allocations and prices as much as expectations. Okay, so it looks implausible to think that we do nothing and nothing happens. Could it be that the market expects that we will be masters of adaptation and management and emission reduction, etc.? Well, this is again very optimistic, because we are very uncertain about temperature outcomes given CO2 concentrations. So probably one of the biggest areas of uncertainty is policy. We do not know whether next year Trump will be re-elected. If he is re-elected, he has already said that he will go back, pedal back, repeal many of the initiatives that have been taken by one of the biggest emitters in the world. So policy uncertainty is huge. But even if we say, let's assume that we know perfectly policy, it is poorly appreciated how even the physics of the problem has a huge uncertainty. And I don't mean by the physics of the problem as uncertainty in terms, is it anthropogenic, does it exist or not, but what will be the temperature outcome? We'll look into this in a minute. Second, why thinking that successful mitigation will be a picnic? Well, policy changes, as I said, required for the soft landing are unprecedented, both quantitatively and qualitatively. In the book that I just finished, I refer to a successful tackling of climate change as nothing short of a war effort. And we have to keep in mind the possible development trajectory of those parts of the world that have not experienced sustained economic growth to date. I'm thinking, for instance, sub-Saharan Africa. We'll come to this in a moment. So, we have been obsessively thinking about 1.5 to 2 centigrades, which is a good aspirational target, etc. But I have a bit of a problem, because the very way we phrase the problem between 1.5 and 2 seems to imply that we can steer our emissions to achieve a desired temperature with a 1/10 of degree precision. Otherwise, it wouldn't make sense to have the differentiation between 1.5 and 2. And this is the impression which is conveyed by graphs such as this. What are these graphs? Well, these graphs indicate the top one is the CO2 reductions needed to keep global temperature rise between 1.5 centigrades. The black line is where we are at the moment. And as you can see, in as little as 7 years, this line becomes vertical. So we have used all of our carbon budget. So in 7 years' time, if we are at this level here, we basically have used up our carbon budget. It looks a tiny bit more optimistic, not optimistic, doable for the emission parts consistent with 2 centigrades, but it is just a factor of a scale. I'll show you this picture in more clearly in a moment. But the point I'm making here is that there is an excellent source, Our World in Data by Oxford University, but they only give you the expected value, the central estimate of temperature. There is a huge dispersion around this. How huge is dispersion? What I've plotted here is a probability density, so probability for different values, of a key quantity in climate science, which is called the equilibrium climate sensitivity. What is that? That is the equilibrium change in temperature for an instantaneous doubling in CO2 concentration. And this is the best physics available at the moment, and it has an uncertainty that goes, okay, the expected value is 2-point-something centigrades, but I have a probability of about 10%, and it might be above 5, and it could also be below 1. Notice how skewed towards high values this is. So the point I'm making here is that we have huge uncertainty, even if we assume to know exactly the emission paths. And as far as emission paths are concerned, please take a look at figure 9. Figure 9, which is the top figure, shows on the left side, the emissions, historical emissions up to last year. And the remaining, the thing that falls down like a stone on the right, is the emissions that have to happen in order to produce an outcome of 2 centigrade, not 1.5 by the end of the year. This is unprecedented. This is the complete change in trajectory that is required here. And the second graph shows you something different. These are all different temperature outcomes, and from these are we have in our research group we have reinstalled the 17 models which are IPCC approved models, and this is the spreading temperature. So even if we know perfectly the emission schedule, by the end of a century, the temperature could be either 1.6 or 2.6. This is the degree of uncertainty that we really have. So investors should be factoring in massive uncertainty. Okay, perhaps investors are putting a lot of confidence on the fact that climate risk will be successfully mitigated. How reasonable is this? The change that I showed here in the top figure is extremely fast, sudden, and extremely steep. If not at global level, has a similar rate of decline been observed, at least for some countries? And if so, what are the policy choices of these fast abaters? Is it reasonable to expect that the experience of these countries can become a template for successful decarbonization? In this discussion, one is to distinguish very carefully between developed countries, already developed countries, countries which are developing fast at the moment, such as China and India, and countries that still have to embark on the development path. And it is in my contention, by the way, that the third category is what holds the key to future global warming, and we'll come back to that. Part of the reason is that countries that still have to develop are so important that the early stages of development rely heavily on sectors such as steel and cement that are very difficult to decarbonize. We're going to see this for a moment. So here I'm focusing on this still to develop country, and I'm looking at what has happened in countries which have succeeded in the development trajectory. And I have India and China here, and I have on the same scale CO2 emissions and the total emissions and the emissions coming from cement. Why am I focusing on cement? Because cement and steel are two predominant uses of energy for developing countries, countries that are beginning to develop, and they are very, very difficult to obtain with renewables. And so look at India and China. Now, if we look at cement emissions versus total emissions in a developed economy, such as the US or France, notice that I had to use two different scales. And one scale goes into the thousands, and that is the total, and one scale goes into the tens, which is for cement. When the country becomes developed, then cement use stops growing, because you don't have to build infrastructure, you don't have to build roads, you don't have to build more houses, etc., etc. In countries such as Nigeria and Kenya, which are prototypes of countries that are beginning to develop, you can see that the emissions due to difficult to abate outputs such as cement are of the same order of magnitude as total emissions, as you can see. So, if we focus on cement-related emissions as a proxy for emissions that are difficult to curb, we have strongly developed countries, and still to develop countries that all go at different paces. I can skip this, and let's come to an optimistic estimate. Let's say, okay, I keep this in mind. I do have in mind that there is a possibility that if these countries, if Africa becomes a new China, it's a completely different ballgame for climate change. But let's look at the best in class. So the countries that have abated most effectively and most quickly. And what can I learn from this? Well, apart from the dip that is due to the Second World War, the biggest, the fastest emission has happened in France. And you see from the peak here how emissions in France have plummeted. No other country has had such a fast decline in emissions, but this has been due to a very peculiar and French choice, which has been the embracement of nuclear. And you can see exactly in the bottom picture here that the decline in oil is exactly coincidence with the increase in nuclear. So, if we consider that the fast pace of emissions experienced by the fastest was due to a nuclear choice that very few countries, for one reason or another, seems willing to embrace, and that even if the French rate of emission reduction were universally adopted, is still not be strong enough to get to the 2 centigrade targets. And many highly emitting countries are still increasing their carbon emissions. Putting all of this together, it seems very unlikely that the pace of abatement will be as high as is required to come down as required. So a soft landing scenario is not a central scenario. That's the key point. We are coming to the last point, which is perhaps the damages will happen, but they are so far in the future that everything will be discounted away. So when we discount something that happens in 50 years' time to today, it doesn't matter. Let's go a tiny bit of theory. In the simplest case of certainty, I have that my rate of discounting should be equal to the rate of impatience. That could be anywhere between virtually 0, as Professor Stern says, or 1.5%, as Professor Nordhaus said, plus G is the rate of consumption growth, closely linked to the rate of growth in the economy, times the inverse, let's call it risk aversion. It's actually the inverse of the elasticity of intertemporal substitution. Anyhow, this equation is obtained for certain cash flows, and is a very dubious, is very unpalatable to assume that cash flows are certain in a situation like this. If we allow for uncertainty, we add a term that decreases the rate of discount. So additional uncertainty should decrease the rate of discount. However, there has been such a huge disagreement about what the correct rate of discounting should be, that one may say, really, I can't know anything positive about this. Not true, because Professor Weizmann from Harvard University has shown that in the case of uncertainty about the correct discount rate, the distant cash flows should be discounted using the lowest possible rate. And with a not particularly low discounting rate of 2%, cash flows in 40 years' time do not disappear. They are reduced by 55%, and this is in 40 years' time. So even if we think effects will be out in the future, they should still be very, very visible. So even if climate damages are a very long way in the future, they will still produce a change in discount rate, and this should produce a change in prices. So we are approaching conclusions. Black and white description of the current global warming predicament points to 2 polar scenarios. If we control effectively climate change, the world economy has to transform in a way that some macroeconomists have described as precipitous. If we do nothing, we're going to venture into uncharted climate waters with temperature fast approaching at perhaps exceeding 3 centigrades. Of course, there are shades of grey, but there is a huge uncertainty even about the physics of the problem, let alone the policy, let alone the damages. Even the more benign scenarios hide behind a facade of a smooth aggregate transition profound macroeconomic shifts which must have deep sectoral price reverberations. In either of the polar scenarios and in all the intermediate outcomes, transition in physical climate risk will have large aggregate and or differential impacts on cash flows of firms and governments. If these differences, if these impacts have not been properly factored into current valuations, then we should expect significant price adjustments. If these price adjustments are going to be gradual, this will create a long-term drag on portfolio return. But this will be the most benign form of repricing. There are precedents for much more sudden price adjustments, and one needs to look no further than the 2008-2009 subprime crisis, for which I have something to show you here. Now, this is, oops, something terrible has happened. I don't know why. The top figure is upside down. So it should read, it is the Nasdaq index, but it has somehow has been flipped. The point I am making, trust me, between 30th of December 2006 and virtually the month before Lehman, the Nasdaq index had gone back exactly to the same prices. Then it's not that prices go down after Lehman. For some reason, this picture has flipped. So remember, up to 1 month before Lehman, the Nasdaq index was exactly at the same level as in December 2006. However, the non-investment option adjusted spread doubled as early as February 2008. And if you look at base correlation, which is a technical thing but indicates the value of credit derivatives, the shock occurs much, much earlier than 2008. This is where Bear Stearns is beginning. That is, the BNP Paribas withdraws the special purpose vehicles. So you immediately see this big jump in base correlation, a more gradual but still significant jump in non-investment option disaster spread, up until the last moment, no jump at all in the equity markets. So there are precedents for the equity markets moving. This used to be called in 2008 the Wile E. Coyote syndrome. You know, Wile E. Coyote that goes off the cliff, it keeps on motoring for its legs for a while, and then it falls down. Can one guess the timing of the readjustment of this Minsky moment? Every real world or financial crisis, COVID, Russia, Ukraine, disruption to energy supply, inflation shocks, temporarily pushes climate abatement off the attention radar and delays the transition. The more crises we experience, the larger the final readjustment is likely to be. Can one guess the timing? That is as easy as catching a falling knife. However, the high level of public and corporate debts makes investments in abatement policies more difficult. Also, in this respect, every crisis reduces the available resources for abatement. Military support for Ukraine, COVID furlough schemes, fiscal help for an energy crisis. Government intervention is more needed for the second phase of decarbonization: removal, capture, and storage. Fiscal room and willingness to raise taxes worldwide are limited. All of this can only delay the enactment of effective policies. What could trigger the repricing? And here is my last slide. Extremely difficult to tell. If sudden, the Minsky moment could be due to an exceptional weather event, perhaps localized in a major Western urban center with high media coverage. Also, an unexpected and sweeping regulatory move could have a catalytic effect as well, and the two could be linked because to have legitimacy, it is more likely that such a regulatory move comes in the wake of a major Western event. This is speculation. I really cannot say more about this. But this is my conclusions. So I try to make a case why I think it is unlikely that prices correctly impound climate information, and therefore, sooner or later, I believe, a readjustment, gradual or sudden, is very likely to occur. Thank you very much.
So I see that there are a few questions on the screen. Do not hesitate to send your questions later on, because we will answer to them later on, if not today. So I will select some of them. So there's two which are quite similar, let's say. So I will read them to you. So could it be that the muted reaction is caused by the unknown effects of climate change, by the unknown magnitude of what is already priced? For example, similar to the effect of the rabbit in front of the cobra?
Well, I don't know very much about rabbits and how rabbits do in front of a cobra. I thought that they ran away, but apparently they do something else. But the point I'm making, you're absolutely right. There is huge uncertainty about the effects of climate change. However, and this is a key point, if uncertainty changes, allocations change. This is my Markowitz Finance 101. If I increase uncertainty, and uncertainty is obviously huge in this respect, the equilibrium allocation, how much money is devoted to different sectors, should change massively. And they should leave an imprint in the prices. And that is what I'm not saying. I'm not saying for a second, I am sure that this outcome or this outcome will come out. But I am sure that there is huge uncertainty. Uncertainty changes prices.
There is also a question to see if we can assess the difference between, when we say climate risk, is there a way different between transition risk and physical risk? Is it assessed or under-assessed the same way or differently?
Yes, I have mainly referred to physical risk. Clearly, transition risk only makes sense if there is physical risk behind. So transition risk is a political consideration, which is extremely difficult to predict. However, I am focusing on physical risk because whatever the policies we might decide to do or not to do, the physical risk remains. And therefore, it is in a way more solid and more uncontroversial. If I may, Fanny, I see a question here that I'll begin to read, wondering what your thoughts are on the integrated assessment model being one of the key drivers of the asleep at the wheel problem. This is a very important question, and probably people refer to the DICE model. There has been a lot of bad publicity about the DICE model. First of all, the DICE model was created decades ago. The DICE model is not a single model, is a conceptual framework. No serious economist at the moment is using the original DICE model with the original parameters, with the original assumptions, in order to draw any conclusions. But they still call it the DICE model. We are using a DICE, what we refer to as a DICE model, but the utility function has changed, the damage function has changed. So every module has been changed in line with the best information. So integrated assessment models do not mean the DICE model of 30 years ago. If disingenuously some people want to use the outcome of these outdated models and models that their authors perfectly recognize, yeah, we'll do something different today, that has nothing to do with the models. Integrated assessment models can provide a very useful way of thinking about climate change. Also, all these models, remember, they were created with the policy intention in mind. With the policy, you're exploring temperature ranges around the optimal level. We can discuss 1, 1.5, 2, 3 maximum or thereabouts. So the damage function in these models has to be reasonable for this range of temperatures. If people who, if I can say so, don't know what they're doing, use their models for scenario analysis without changing the damage function, this is the responsibility of the people, of the sorcerer apprentice who are using something they don't understand, is not the fault of the model itself. The models have evolved, there is no such thing as an economist consensus about the damage function. There are some economists that say very low damages and some economists that say catastrophic damages. So again, these models give you a way of incorporating your uncertainty and quantifying your uncertainty on the basis of the best scientific evidence. So, and last thing, it is true that the original DICE model was, by modern standards, wanting and inadequate in several respects. However, if policy had followed at least the recommendations of the super tame DICE model, we would be in a much, much better place today than we are at the moment. The reality is that we have not even followed the recommendation of the DICE model. The $30 per ton of carbon tax might be certainly is too low, but let's not forget that today we are still subsidizing carbon emissions. So it is, in my opinion, disingenuous to say that the best state that we are in is because we have been listening to these models on several accounts. How are we doing with time?
Riccardo, there is also a question on, so you mentioned several times the impact of policies. There is also a question linked to regulation requirement as well to have a sufficient buffer in terms of liquidity and protection. So I don't know if you want to answer to this one as well.
Not
the importance
sure.
of
I'm not
legislation.
very clear about the question. Can you tell me, so for which institutions is this question?
I'd expect it's financial institution, maybe.
Yeah, but is it a bank? Is it an insurer? Is it an asset manager?
I don't know.
Why don't you send me this question by email with a bit more details, because I don't think that there is an answer to this.
Sufficient time, yes, to answer to that one. Okay. Several as well participants are asking if you could as well later on communicate studies or references to deep dive in what you have mentioned earlier, maybe.
Definitely. I'll be very happy. By the way, there is a paper of mine which has been published in Journal of Portfolio Management, but I'll send you also a list of references to lots of papers in this area. Absolutely. Yeah.
So there is a question, quite interesting one. What method do you propose to convey this conclusion to infrastructure investors and governments? One infrastructure fund answered my question as to how they were accounting for climate risk by saying that's a matter for an insurance company.
Tell me the question again. Funny, you're picking really tricky questions. Tell me again.
Sorry. What method do you propose to convey this conclusion to infrastructure investors and governments?
Okay. Let's talk one at a time. So from the perspective of an investor, infrastructure and or otherwise, there is an important thing. If you're a policymaker, you should, in the presence of uncertainty, you should lean in the prudent direction. This is called the precautionary principle. This is for policy. However, from an investment perspective, there is no safe way to be wrong. So if I go for the most catastrophic projections and I'm wrong, my portfolio is going to be full of cash, it's going to be full of treasury bills, it's going to be full of gold and other defensive assets. If the catastrophic projections do not materialize, and these projections were wrong, I will underperform, not an aggressive, but even a middle of the road scenarios massively. And obviously, if I'm over-aggressive, I will have exposure, then if the bad scenarios happen, will be very negatively impacted. Again, the point is, if I put my old investment committee hat on, in those situations of a high uncertainty, I create a barbell portfolio, a portfolio which is partly defensive and partly aggressive, and any combination in between, and I might use quantitative. And it is true for infrastructure, it is true for any type of investor. Again, it goes back to the point In the presence of high uncertainty, allocations change. And the allocation change either formally, if you follow a Black-Litterman, if you follow a Markowitz model, or in a more subjective way. But given that you know the degree of uncertainty, you adapt your portfolio accordingly. There is no safe way to be wrong. Just believing that the most dreadful projections are true doesn't make your portfolio safe.
Thank you, Riccardo. I think we are approaching to the end to our webinar. Do you want to take a last question, sorry?
Yes, I can see here. Could it be the physical risk are not sufficiently primed in because the market believes in Nordhaus' prediction that impact will be mild? I think I've already answered this, but I think it is important to say. Nordhaus has used a damage function that was only conceived for policy purposes. For policy purposes, it's only necessary for the function to give a reasonable answer between 1.5 and 3 degrees. I have run the optimization a la Nordhaus, and high temperatures never even come up. So again, Nordhaus might have chosen an inappropriate damage function, but it's inappropriate only if you use it for scenario analysis. So the bottom line is, don't use a function that Nordhaus never intended for scenario analysis, for scenario analysis and stress testing, which is what many consultants to UK pension fund trustees have done. The Research Institute has just published a white paper exactly on this topic.
Thank you, everyone. Thank you for your attendance. I think we have a lot of questions to answer now. As we said before, so we will send you the latest paper published by Riccardo, the presentation, and make sure we answer your questions. Yeah. And any references as well that you have asked for as well so far.
Thank you so much.
Thank you. Have a good day, a good evening, depending on your connection, and hope to see you in another webinar. Thanks. Bye.
Thank you. Bye.